Other than REITs, real estate investment trusts, my first passive real estate investment that I ever made was a crowdfunding investment. Denny and I used to have, we still have that blog, but it's not as active as it once was. But our blog used to be our main form of content. Now we record these videos, of course. And I used to write all the time about my personal experiences investing in real estate crowdfunding platforms like Fundrise, like Streetwise, Concrete, Groundfloor. And we'll dig into all these in a minute. And
Brian, just for those people that don't know,
yeah,
explain
so back in the
crowdfunding.
early 2010s, there was a new regulation passed by Congress that allowed for what they call Reg CF, or regulation crowdfunding investments, as a classification for the SEC. So it opened up companies to start allowing retail investors to invest relatively small amounts in passive real estate investments without having to be an accredited investor. And that's a whole other conversation, and we can touch on that briefly. But that is one of the challenges of going out and investing in, say, private equity real estate, like we often do in our co-investing club, is many of those, not all, but many of those investments
Right.
do require you to be an accredited investor. So have $1 million net worth or higher, or $200,000 income or higher if you're single, 300,000 if you're married. Yeah, which is obviously a small percentage of Americans, right? And there's a whole reasoning behind that, which we don't like, but it is what it is. That it's the law. Um, and just want to point out again, there are many of these investments that do allow non-accredited investors, which is what we typically focus on at the co-investing club. But anyway, crowdfunding investment. Yeah, this really launched in the 20s because of this new law that was passed. A new set of regulations. Now, I had good experiences initially with most of these platforms, and I wrote about these platforms on our blog. Because I wanted to have a firsthand perspective with a firsthand experience writing about these. And I've been really disappointed with most of them, especially since 2022 when interest rates went through the roof. Fundrise, in particular, has really disappointed. So they have a net, or I personally, my account has a net annualized return of 3.4%. And that goes back to 2018, I think. Yeah, it goes back pretty far. And that's
Wow.
just spread among a bunch of their funds, like their flagship fund, et cetera. That's not like me picking and choosing niche investments in there. So they've really underperformed. And, Denny and I, in the co-investing club, we have actually bought into deals that were distressed assets that the operator was buying from Fundrise because they were so badly managed. So, yeah. So,
That's
I have
right.
lost my faith in Fundrise, sadly.
Are there any platforms
There are
that
a
you
couple,
think
but
are
before we get
better?
into the ones that I think are doing all right, I will call out a couple that have also underperformed for me. And by the way, in the video here, we'll share some screenshots of my actual accounts and how they've done, and we can link to those in the show notes as well for anyone listening over podcast. Arrived Homes really has not performed well, so I've invested in 17 properties on their platform. And these are fractional single family rental properties where you invest $100 and you get, a tiny fractional ownership in a single family rental. And that has earned me an annualized return of 3.8%. So also very underwhelming, especially compared to the stock market, which has done well, and compared to a lot of the passive real estate investments that we've made in the co-investing club. And that
Right.
3.8%, that is almost entirely, 99.5% of that is from rental cash flow, not from appreciation. So, and they do
Wow.
calculate appreciation when they run those numbers, when they report those numbers to you. So, not impressive returns. And, 17 properties, that's a decent sample size. That's not trivial. It's not like 2 or 3 houses. I mean, it's 17 houses that I've invested in. So, a reasonable sample size. And the problem there is that these companies in general, half of what they're doing is polished marketing, right? So arrived.com, their business model is basically buying brand new homes or almost new homes that look great on photographs on their website, right? But that's not how you make money on rental properties. I mean, I used to do this myself. I used to be a rental investor.
Mm.
The way you make money on rental properties is buying distressed assets. And then, whether it's a distressed owner who's in foreclosure, whether the property itself is physically distressed and needs major renovations, but going out there and buying off market properties, not listed on the MLS for full market value like these properties were, but going out and buying distressed properties off market,
Right.
fixing them up, cleaning them up, and then running them at full market value. So that's not what they're doing because that doesn't look good on a website.
Not to mention the tax benefits.
Now, what's that, Denny?
Not to mention that, are there tax
No.
benefits with a crowdfunding? Because you definitely have tax
Yes, if
benefits
you're
when
talking
you
about
do it on
syndications,
your
which is
own.
one of the types of investments that we make. in the co-investing law. So
Right.
not every passive real estate investment comes with tax perks, but some of them do, and in particular syndications. The worst performer of all has actually been Streetwise. They own a portfolio of office buildings, and they're down. My portfolio with them is down 31%. Like lost 31%. So at least Fundrise and
Wow.
arrived. At least they've
That's
delivered
crazy.
positive returns for me. Over the years. Even if they're unimpressive, Streetwise has lost me 31% of my. Yeah, so they've really underperformed. All right, you did ask me about real estate crowdfunding platforms that are better. So my favorite real estate crowdfunding platform is Groundfloor. They're not perfect, but they have averaged pretty consistent returns in the 8 to 10% range, which is comparable to stocks, right? Long-term average returns on stocks. Now they're not
Sure.
liquid like stocks are. You can obviously go on your brokerage account and sell any stock at any time, or any ETF, right? So ground floor, these are notes that are secured by investment properties, and you can buy in with relatively small amounts. $10, I think, is actually the minimum. I think it's still the minimum. It used to be the minimum. They may have raised it. Yeah, so that's the average return on these. Some of them lose money, some of them overperform a little bit. Most of them pay as agreed. But yeah, if you look at their entire portfolio, every year, it usually returns in the roughly 8 to 10% range, which is totally solid. So, I've been mostly happy with that. The problem is that the ones that underperform, and ones where the borrower either defaults or doesn't complete these are mostly hard money loans that they make, by the way. So they're supposed to be short-term loans for people flipping houses or doing the Burr method with rentals, right? Problem is some of these borrowers get in over their heads and they don't actually complete the project on time. And these drag for year after year after year. So you don't get your money back and it's locked up for an indefinite amount of time. Sometimes Groundfloor has to foreclose on these, of course, and that's when they typically lose money on these.
Wow.
But there's an indefinite lockup period with these, which is annoying, frankly. Now, granted, in the co-investment club, well,
What do you
these are
mean
supposed to be
indefinite?
relatively short-term investments, right? Like they're supposed to be like 6-month investments. They can last for years, and I some of them in my portfolio are outstanding from years and years and years ago. So yeah, now
Wow.
obviously some of the investments that we make in the co-investing club are longer term investments and there's no liquidity, and they are indefinite in the sense that there's not an exact sale date, but that's because the operators typically wants to leave themselves some freedom to either sell early if it's a good market for selling that comes along early, or if it's a bad market. Most of these will target
Right.
around a 5-year hold. But after 5 years, if it's a bad market for selling, maybe they'll hold an extra year or so, right? But you do go into those with the attitude of, oh, this is a long-term investment. I'm going to be locking up my money for some time, and I will be collecting cash flow in the meantime. In most cases, these notes don't pay any cash flow; that you just get your interest on the back end. So that takes some of the fun out of it, out of holding these, especially when they go long-term.
And why not
Yeah,
use a savings
yeah.
account?
So,
Just
but
kidding.
ground floor, they have been pretty consistent. So, shout out to them. And we do have, we'll put links to all of these, we'll put all these links in the show notes. They are, many of these are affiliate links, by the way, just so that you're aware. But Concrete is another one that, has been pretty stable and solid. They move their yield around a little bit. Usually it's between like 5.5% and 7%. Right now they're paying 6.65% yield. And it's a big lumped pool of notes and the occasional equity investment as well. And the advantage with them is that they do offer more liquidity than your typical passive real estate investment. So there's a 2-month lockup period where you can't get your money out at all. But after that, you can pull your money out and usually get it back within a week. They don't guarantee a week, but in most cases, they can pay this out within a week. And I've tested this myself, and I did actually get my money back within a week or two. Yeah. Now they do charge
Oh,
a
wow.
fee if
Okay.
you withdraw within the first 2 years. So if you withdraw your money in less than 1 year, it's a 2% fee. In the second year, if you withdraw, it's a 1% fee, and then after 2 years, there's no fee at all for withdrawing your money. But Concrete, they pay a weekly dividend, which is kind of nice. So again, 6.5%, the 6.65% that they're paying right now, that's not going to light the world on fire, but it's not bad either. And the weekly dividend is kind of nice. Just every week you get that in your account. Yeah. Let's give actually, before we wrap up, let's give a really quick summary of the types of passive real estate investments that we make, because we make a bunch of different ones. So we do real estate syndications in the co-investing club, of course. We will do private partnerships with operators like house flippers, where we'll partner with them on a couple of house flips. We do private notes at a fixed interest rate to receive interest. And we will sometimes do equity funds or debt funds as well. And short-term, medium-term, and long-term investments, we mix it up. Denny, anything you want to add before we call this episode complete?
Just that, because of the small amounts, you can diversify, which helps you, protect
Man.
your
And yeah, if you
investments
guys
all
are not
around.
familiar with those passive real estate investments that we just outlined, we do have a free course on them. sparkandall.com/free. 8 episodes. They're all super short and sweet, like 5 to 10 minutes. So check that out if you're curious about how those types of investments work. And if you got a fresh perspective out of this episode, please pass it on to friends and family. And on that note, stay weird, unconventional investor.
See you later.